Equity session lows, live from New York City this morning. Good morning, good morning. We're down 0.75% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, the UAW said to be planning a counteroffer to Ford, China looking to broaden its iPhone ban to state firms, and Biden to cancel Arctic drilling rights sold by Trump. We begin with the big issue, King Dollar.
You've got a strong dollar story.
Strong dollar.
Stronger dollar.
The US economy continues to plough forward pretty strongly.
Continues to do well.
Dollar strength is about a lot more than just the US story.
Really is a reflection of the yield differentials across the globe.
Activity elsewhere in the global economy is slipping.
On the back of some disappointing data from the euro area.
It's also very much the case in China.
The Fed is, with its rate differential, keeping the dollar aloft.
If the Fed does eventually cut rates in 2024,
if we get some relief on inflation, for the Fed to back off a little bit,
you do have the basis then for a somewhat weaker dollar.
For the dollar to come down.
If the Fed is going to start again, I think we're going to get a significantly stronger dollar in the next leg.
More dollar strength.
King dollar is going to be king dollar.
We're seeing certainly a return over the last couple of months of US exceptionalism.
To discuss, Matt Hornback, Morgan Stanley, Mike Schumacher, Wells Fargo. Matt Hornback, the euro against the dollar, 106.95. Matt, for you, what underpins this dollar move and how sustainable do you think it is?
Well, John, thanks for having me. And I think your opening bit there covered quite a lot of the issues at play. We definitely have a combination of global growth weakening, particularly in Europe, followed by China. And then we've got what appears to be resilience in the U.S. economy. So that has allowed interest rate markets in the U.S. to keep hope alive for another 25 basis point rate hike from the Fed. And I do think the rate differential story does benefit the U.S. dollar, particularly when you look at real interest rates in the U.S. pressing up against fresh highs.
Matt, do you think that resilience in the U.S. data is somewhat overstated?
Well, and it also it depends on what you're looking at. You know, if you look at claims this morning, obviously there was some hurricane effect in the state of Florida, but if you look at claims, you'd think the economy is on fire. If you look at the downward revision to hours worked in the second quarter productivity report, you might think something differently is going on in the labor market. So it's really in the eye of the beholder, and it depends on what data set you're looking at.
Mike, there's a bit of conflict here, isn't there? Yesterday, a perfect example of that. The Beige Book says soft landing to some extent. The ISM said no landing at all. How much weight would you put on one data point versus the other?
Pretty little, frankly, John. You've got to look at the broader story here. So labor market, yeah, weaker than it had been, but still strong. Growth tipping a bit, but generally speaking, I'd say I wouldn't attach a lot of weight to any particular data point. And when you think about market movers, Beige Book, frankly, and ISM even, don't really stack up in general. So we're not terribly concerned about either of those prints.
Well, Mike, you've got a big call. Go big or go home. We expect the 10-year Treasury to end the year around 350. So let's go big right now. Your 10-year, 428. What's taken us to 350?
Yeah, a couple of things. So first off, and Matt mentioned this, real yields are very high in the U.S. There's no escaping that, John. And really, when you've got the 10-year plus or minus 2%, that's attractive to lots of types of investors, whether it's big institutions, even the retail folks. They can't really miss that. The second thing, which we think is more important, and I think it's really a critical point for anyone listening to the show at this point, is that the Fed and the big central banks, they're about done tightening. Does the Fed go one more time? Maybe. Does it matter a lot? Not to most people. The big story here is when central banks finish tightening, and the Fed included, you generally get a very strong rally in bonds. And people say, well, the cycle's different. Could it be different? Sure, it could be, but I would argue that the move is probably at least as intense as we have had historically. So that sets the stage for a pretty big rally in 10s toward the end of the year.
Matt Hornback, can you get on board with that?
Yeah, John, and our current forecasts are currently at 3.5% at the end of the year as well. So we do attach a lot of weight to this idea that the bond market can stage a pretty meaningful rally into the end of the year. And look, one of the big drivers for us is what has been going on with fiscal policy. We've had a tremendous amount of support to economic activity over the past year with a 5 percentage point of GDP increase in the fiscal deficit. I know a lot of people poo-poo that, but I mean, that is a massive increase in the fiscal deficit that had to have provided a tremendous amount of support to activity, and that's fading, John, really starting now over the course of the next 12 months.
So, Matt, you've also mentioned as well in your research over at Morgan Stanley the resumption of student loan repayments as well. We know there's a 12-month on-ramp, so to speak, for those repayments. Why do you think that might begin to hit to bite this economy later on this year?
Well, look, I mean, we know that people have been dipping into those excess savings that built up during the height of the pandemic period, and we know that those excess savings have been drawn down a decent amount. You know, there's different opinions on that, but generally speaking, people have been dipping into savings. They've been tapping credit card balances to support their spending, and we're seeing evidence that demand for labor is softening while more people are going back into the labor force to try to get work. And that ultimately does speak to the need for more income. And so, yeah, at the end of the day, if you don't have a lot of savings and you're going to have to start making student loan repayments, you're going to need to find another job. And that speaks to us to be more weakness in demand and more supply, which means wages are going to come down, John.
And yet with that, Matt, at the same time, we've still got a 10-year near cycle highs, 436, that cycle high, the 10-year right now, 427. We've still got crude near the highs for the year. Matt, a favourite question of mine at the moment is whether those moves reflect an extension of the cycle or whether you believe that's a recipe to end it. Do you lean into the latter and not the former then?
Well, I mean, this is what markets do, John. Markets can overshoot. They can run with themes or narratives for too long, and ultimately that sows the seeds of the next leg of the cycle. Which, yes, so this tightening in financial conditions coming through oil, coming through the equity market, coming through the U.S. dollar, coming through U.S. interest rates. Yes, this tightening in financial conditions will end up showing up in the data, no doubt.
Crude a little bit softer here. We're down 1/3 of 1% on Brent crude, $90 and about 25 cents on WTI. $87 and about 13 cents. Economic data behind us, in front of us, a ton of Fed speak. With more, let's get to Mike McKee. Morning, Mike.
Good morning, John. Well, we did have some surprising data again today. Jobless claims not doing what you'd think they'd do if the Fed is raising rates and slowing the economy. Take a look. We're not only back to where we were pre-pandemic, and I cut the pandemic out because it throws the chart off so much, but the jobless claims numbers and the continuing claims numbers are still falling. 216,000 for claims, 1,679,000 for continuing claims. This is still a tight labor market. Does that mean that the Fed should be raising rates? Well, we will hear from a lot of Fed officials today, but take a look at yesterday's Beige Book as perhaps a guide to what they might be thinking. What you're seeing here is references to the word slow or slowdown and references to the word recession increasing significantly over the past couple of Beige Books. Now people are beginning to talk about the economy slowing down. CEOs telling the Fed, various Feds around the country, that we may be at the end of consumer spending. And then you were talking about the dollar. I thought I'd throw this in here. The Fed has to worry about it. They won't talk about it in terms of its value, but they do have to worry about it. And here's why. Because when the dollar gets stronger, it hurts import. It hurts our exports, but it helps import prices. We should see import prices go down, but look what happens on the bottom scale there. When the dollar gets stronger, it tends to push up interest rates in the U.S. So the Fed has sort of a good news, bad news situation when the dollar is getting stronger. So something for them to keep an eye on. And of course, we will be talking to somebody about that this afternoon. If only there was a Fed leader we could ask about all this.
Well, Mike McKee, we'll put up the promo right now for you. We've got the graphic ready. I'll go through the Fed speak while we do that. Harker, Goolsbee, Bostic, Bowman, Logan, all today, and John Williams, the New York Fed president. Can you give us a sneak peek, Mike? What's the conversation going to be like later on this afternoon?
Well, obviously you have to ask if they're going to go another time or not. But then the question becomes, as the gentleman you're talking to, Michael and Matthew, are talking about, what happens after that? Does the Fed start cutting? because they see recession? Do they start cutting because they want to keep real rates from rising too far? Or do they just hold because they need to continue at a high level to stamp out inflation? A lot of ways the Fed can go, and we'll talk to the vice chair of the Open Market Committee about which way he thinks they should go.
We'll take that live and in full right here at Bloomberg on TV and radio. Mike McKee, thanks for that. Matt Hornback, Mike Schumacher still with us. Mike Schumacher, first to you, sir. What would you like to hear from John Williams a little bit later on this afternoon?
What I'd like to hear is John to say, hey, Mike, that's a great call, 350 on 10s. We can make that happen for you. But I think a little more realistically, I think he's going to say basic platitudes. Hey, we've done a lot of good work, a lot of tightening still in the pipeline. The economy is going to feel the effects of very high real rates. We talked about this a bit already, but think about real Fed funds bumping up after CPI next week. It's going to look close to 3%, which is pretty wild. So I suspect John Williams will say something along the lines of, hey, we could consider easing next year if reals are still very, very high. Something in that vein. He's made comments like that recently.
All this Fed speak going into the quiet period, which commences this weekend, then going into next week, it's all about CPI on the 13th of September. Matt, there's a sense that no matter what we hear today, rate hikes are on ice in September. Are you on the same side as that? Have we seen the last hike from the perspective of you and the team at Morgan Stanley?
Yeah, so Ellen Zentner, our chief U.S. economist, thinks the Fed is done hiking rates, and on the strategy side, we see it the same way. The markets are mostly there, but the real debate amongst investors is whether the Fed goes again later this year, whether it's November or December. The market is attaching a relatively high probability to another rate hike. And I think part of that links to what some people are forecasting as a rebound in core inflation in the U.S. So that's where the rubber meets the road is, does inflation continue to soften into the end of the year, or do we get a rebound? And then what does the Fed do with that?
Matt Hornback, Mike Schumacher, going to stick with us. We'll build on this conversation in just a moment. Going into the opening bell about 20 minutes away. Equity futures are negative here by 0.75% on the S&P 500. Apple at the epicenter of the move in the last couple of days. Let's get you some movers. Here's Abby.
Apple is absolutely at the epicenter of this three-day decline, especially yesterday. Apple was down nearly 4%. In the pre-market, a similar move lower, John, so down about 7% over 2 days. That China ban on the iPhone has extended to, as you were mentioning earlier, government-backed agencies and state companies. Now, China is about 19% of their revenue. Wedbush is saying this is overblown, but technically this stock is breaking down and is likely to continue to weigh on the major indexes with its big weighting. NVIDIA down 3.2%. September is a challenging month for this company. Last year down about 20%. The year before that down 7.5%. Right now into today down 5%. So NVIDIA currently, a September to remember, down about 8%. And then C3 AI, well, it's not getting any better. The AI hype, it's not living up to the hype. The results not living up to the hype. Their revenue forecast was a little bit light. Profitability will take longer than expected. John, the stock, as you know, into this session up 181% on the year. Price for perfection. Investors simply not getting it.
Abby, thank you. More from Abby around the opening bell in about 20 minutes' time. Coming up on this program, President Biden taking a labor deal victory lap.
This contract proves that collective bargaining works. It gives workers a seat at the table and ensures that their well-being, security, and futures are a priority.
This is nearly 8,000 UAW employees at Ford receive a pay boost. Negotiations continue with GM. Team coverage up next.
This landmark contract covers 29 ports, stretching from San Diego, California to Bellingham, Washington, that play a major role in our nation's economy. More comes through those ports than any other means of getting into the United States of America. It's gigantic economic impact. This contract proves that collective bargaining works. It gives workers a seat at the table and ensures that their well-being, security, and futures are a priority.
President Biden speaking from the White House, taking a bit of a victory lap on a labor deal for dock workers as negotiations continue in Detroit. Ford saying it fast-tracked a pay boost for 8,000 UAW employees as of Labor Day. This after the union made a counteroffer ahead of next week's strike deadline. Let's get your team coverage. Bloomberg's AMH alongside Kelly Lyons in Washington, D.C. Kelly Lyons, what's the latest?
Well, I would point out that this raise for these 8,000 union represented workers at Ford is a product of something that was agreed to back in 2019. That is when those negotiations happened. It's just accelerating now the time it takes for a worker to reach the average top raise of $32 an hour. And Ford said in a statement that these pay raises are an example of Ford's commitment to improving the lives of our hourly workforce. And we are offering further improvements in the next contract because, of course, John, it is now the next contract that is of issue here. The current one expires on September 14th, and so we are staring down that deadline for these negotiations to actually result in a deal. And of course, this isn't just Ford. GM and Stellantis are also locked in these conversations with the UAW. And if you remember, just last week, the UAW filed a lawsuit against those two car companies saying that they weren't bargaining in good faith. Now, the latest there is we do expect that GM and the UAW are going to talk today. The union has said it does expect to get an offer from GM. Then for Stellantis, they are expected to present an offer by the end of this week. But time is running short. We are just a week out now from that contract expiration. Remember, the union itself has called some of what it is asking for audacious: 46% pay raises, 32-hour work week, other benefit-related matters as well. And GM has been here before. In 2019, there was a 40-day strike of that automaker in particular that cost the company billions of dollars in EBITDA. So this is really go time here, John. 150,000 workers risking walking out of all three automakers at the same time if an agreement can't be made.
It is go time, Anne-Marie. What's the official line from this White House on this dispute?
Well, you saw it out in the open yesterday, Jonathan. This White House wants to be seen as they are on the side of the unions, especially when they come out hailing the product of what happened between the dock workers in the Pacific and on the ports. But overshadowing that, of course, is this contentious contract debate between the UAW, as Kayleigh just outlined, and these big three auto workers. And it puts Biden in a really difficult place. We already know that there's an individual in the White House that has been working with this, Gene Sperling. He wanted someone to make sure they were involved in these negotiations. There's a lot of consternation within the White House. One, the president doesn't want to see a strike on his watch. What does that mean for the supply chain? What does that mean for the impact on the economy? But also, at the heart of these negotiations, Jonathan, is a pivotal industrial policy that this administration wants to see through. And that goes to electrifying the EV grid. And what you hear from the UAE workers is they want to know if they're not going to be left behind in this EV push. A lot of these battery plants are being developed in the south of America that usually doesn't have a pro-labor union way of working, it just historically. And second, of course, is the fact that they want to make sure that these workers that are working on EVs, that they're coming into the UAW, that they can look at their wages and make sure they're benefiting on behalf of them. So it's a really sticky situation for the president, and that's probably part of the reason why the UAW has yet to endorse his re-election campaign.
AMH, thank you. Anne-Marie, alongside Kelly Lyons down in Washington. Matt Hornback, Mike Schumacher back with us. Matt Hornback, are these the dying embers of a hot labour market or a new regime for labour power?
Well, John, I mean, when we look at what's going on in the supply demand in the labor market, we can see clear trends have been developing for quite some time. And I don't think that these labor negotiations are going to change the macro picture here, which is that the demand for labor is softening. It's every time we get a new labor market report, there are backward revisions downward. And so we know that demand for labor is softening. We also know that supply of labor is increasing. We're seeing it in the participation rate. We're seeing it in the immigration statistics. So we have clear signs that the supply-demand imbalance is becoming better balanced, and that should result in lower wage growth for the labor market as a whole.
Mike, for a man who thinks 10-year yields go down to 350, I assume you're on the same page as Matt on this one.
Yeah, sort of, John, but I take it a little bit differently in the sense that we have is that when you have I agree the labor market's weakening, that does support our call. But as far as a longer-term union negotiation, to some degree that entrenches inflation at a somewhat higher level than it otherwise would be. So where I'm going with this is, what do you think about that if you're John Williams? We talked about him, or Jay Powell. This means that equilibrium level of inflation is probably a little bit higher than they would have anticipated previously. And I think that's what all the Fed officials and ECB folks are struggling with. Where does inflation finally go? So it doesn't really hurt our bullish case, but it does make you wonder where exactly is that final resting spot, if you will, for inflation in the U.S.
It certainly complicates that bullish case to some extent, Mike. When you start to think about where rates would settle down some point in the future when this is all said and done, what are you thinking about, the long-term rates in the United States?
Yeah, I'd break it down pretty simply, John, and say, all right, real yield, what do we think? Maybe 75 basis points, something like that. Steady state inflation, low twos, gets us to 3, maybe 3 1/4-ish on the 10-year long run. Now, long run could be quite a while from now, but is that really helped by something like the UAW? No. Does the UAW case really crush the argument for a big rally in 10s? Not at all. But I think when you focus on the dynamics out a number of years, that's how we look at it at Wells Fargo.
Mike Schumacher, Wells Fargo, Matt Hornback, Morgan Stanley. To the both of you, thank you. Looking for 3.5% on a 10-year yield by year end. Right now, the 10-year 4.28. Coming up, the morning calls, and later, Apple on track to wipe out nearly $200 billion in market value in just 2 sessions. We're down this morning by 3.9%. That conversation still ahead with John Hancock's Emily Rowland. Your equity market on the S&P 500 session lows and negative 0.8%. From New York, good morning. Two-day losing streak on the S&P is about to become 3, about 5 minutes away from the opening bell. Equity futures pulling back 0.75% on the S&P 500. On the Nasdaq, we're negative by 1.3%. Remember the weightings here. Apple at the epicenter of this. Apple lower right now by 3.9% in the pre-market off the back of our report today this morning. China's iPhone ban set to spread across agencies and maybe towards state firms as well. So Apple lower, 11% of the Nasdaq 100, 7% of the S&P, explaining that equity pullback. In the bond market, let's look at treasuries together. Some conflicting data. Beige Book says slow down. ISM and claims say what slowed down. 2-year yield still in and around 5% at 4.99. That's the price action. Let's get you some morning calls. First up, Wells Fargo upgrading McDonald's to overweight, 310 price target, saying the company is poised to benefit from digital initiatives. Your second call from Luke Capital downgrading Roku to hold, seeing little room for error given the stock's rich valuation. And finally, Barclays downgrading Dow to underweight, $53 price target, expecting macro headwinds to weigh on the PC market. That stock is negative 1.8%. Coming up, Apple poised to shed nearly $200 billion in market cap as China is set to broaden its iPhone ban. John Hancock's Emily Rowland joins us at the opening bell, making a case for getting defensive. That opening bell just around the corner. .23 seconds away from the opening bell this morning. Good morning to you. 2-day losing streak coming into Thursday. Based on this, it could well become 3. Your equity market negative 0.75% on the S&P 500. On the Nasdaq, down a little more than 1%. With one stock to blame for some of this, maybe a lot of this, it's Apple. There's your opening bell. Switch at the board and get to the bond market. 3 days of yields climbing into Thursday. This Thursday morning, we pulled back by a single basis point. Your 10-year 4.2698. Jobless claims lower than expected. The right kind of downside surprise for the Federal Reserve trying to engineer a labour market slowdown. Maybe the wrong kind of downside surprise. You'll hear from tons of Fed speakers through today. In the FX market, dollar stronger, euro weaker. Data out of Europe just absolutely terrible. A break of 107 in the last hour, 106.96. At the moment, we're negative by 1/3 on that currency pair. And crude near new highs for the year, pulling back just a touch. We're down 0.4% on WTI, $87.17. 37 seconds into this session, we pull back by 0.75% on the S&P, by more than 1% on the Nasdaq. I want to play the blame game? Here's one. Apple, China, planning to expand its ban on iPhones, prohibiting certain government-backed agencies and state companies from using the devices. Ed Ludlow has more. Morning, Ed.
Good morning, Jonathan. Apple is down more than 4%. As you can see, that equates to to $122 billion of market cap shed. I should say it's on track for its biggest drop in a month. What we are reporting at Bloomberg is an extension of what the Wall Street Journal reported 24 hours ago. They had said, citing anonymous sources, that some central government agencies had told staff that to leave their iPhones at home and other foreign handsets. Our understanding from Bloomberg sources is that there is a consideration this is extended to a broader range of government agencies, but also state-backed enterprises as well. You will remember, Jonathan, you and I 24 hours ago talked about the May edict from the Chinese government for personal computers. In May of 2022, the Chinese government made a very similar decree that a wide range of government agencies and state-backed corporations had to, within a term limit, switch from foreign brand PCs to domestic brand PCs. This is really critically important. Stock's now down 4.8%. Go back to the earnings call on August 3rd. What they had told us is that in China, it was a June quarter record for sales. In the June quarter in China, Apple had swung to revenue growth of 8% from a decline of 3% the prior quarter. But the language was so specific. From Luca Maestri, the CFO, it was that they'd see continued growth in the Greater China region. And Tim Cook said the biggest driver of growth in that market in Greater China was switchers, people that were switching to iPhone for the first time. Remember, guidance for the current period is that sales will be in line with the past quarter, in other words, a small decline. 4 straight quarters of declines would be the longest streak going back 2 decades. So my point here is that based on that narrative from the earnings call, if there's a serious government action in China on the iPhone, that muddies significantly the guidance that we were given on the call, because China was the bright spot.
The stock is down by close to 5%, worst day potentially going back to May of this year. This is the bullish outlook on things, Ed, and I'll share more of the quote from Dan Ives of Wedbush in just a moment. But he says this morning: the recent China news over the last few days we believe is a worst case scenario. Any China government agency iPhone ban is way overblown. As to quantify, it's less than 500,000 iPhones of roughly 45 million we expect to be sold in China over the next 12 months. And I just wonder, though, the optics to signalling for domestic China, for the people of that country. You put it together with Huawei and the story of the last week. Just how much pressure is there on this company going into that unveiling a week away?
Gosh, this is tough, John. But when Huawei came out with the Mate 60 Pro, before you even get to the question of sanctions, the logic in the market was that it would be the champion domestic player. You saw names like Xiaomi fall because they saw Huawei, which has been out of the smartphone market for some time, as a new threat to the domestic players. I guess you extend that logic to Apple, and if the Chinese government is cracking down on iPhone, which is their biggest market outside of America, right, is the Greater China region, is Huawei a threat to Apple? The thing that's muddying this is the geopolitics. I think AMH is probably better on this one, but we are seeing a tit for tat, aren't we, in the last 2 days? The timing of Mate 60 Pro with Raimondo's visit to China, and now the news flow about Chinese response on clamping down on foreign handset makers. I just want to make that point really clear, Jonathan. What we're reporting is principally this is impacting iPhone, but it applies to other non-Chinese handset makers as well.
Got it. A point well made, Ed. Thank you. All of this going into the G20 later this weekend. That stock is down by a little more than 4%. The broader market pulling back by 0.64 on the S&P. The iPhone ban that we're talking about specifically also weighing on Apple's supply chain. Micron, Qualcomm, Skyworks, all under pressure at the opening bell. Abby has more. Hey, Abby.
Hey, John. And this is really a numbers game, because these, of course, are the chip companies that make the chips that go into the iPhones. So you can see how it would be a distress for some of these companies, especially those that gain more revenue from Apple. So there's a great function in the Bloomberg terminal, SPLC. It's the supply chain function. You get to see the supply chains on both sides of a given company. So for Skyworks, 58% of their revenues comes from Apple. Qualcomm, 23%. Micron, 6%. And then Cirrus Logic, 83%. Now, this then becomes a question of the move on the year in terms of what could be ahead for these stocks and valuation. Now, most of these names, they're actually trading at a double-digit discount to the group on valuation. Micron's the exception there. On the year, both Cirrus Logic and Qualcomm up just nominally. And after today, they're actually a little bit down on the year. So you could say it's priced in. Micron up 50% on the year, well, after today, not up quite as much, but a big premium. Again, not a lot of revenue exposure there. Valuation strong, but Skyworks, Sean, this is the one that on the day is hit the worst day going back to October of last year. 17% higher on the year. 58% of the revenue. When you put that together, it's not really priced in yet. You could continue to see Skyworks be under significant pressure.
Abby, thanks for the update. Thank you. I want to stick with chips. Nvidia bracing for another weak September after not having a great history in the month, falling 20% in 2022 and 7.5% in 2021. Isabel Lee on top of this one. Hey, Isabel.
Hey, John. Nvidia is now still softer at around 3%, and it's on track for its second day of losses. But to your point, if history is any guide, then investors shouldn't be too alarmed. But this is important because September so far has been the worst monthly decline since December last year. So we've seen a spectacular rally in Nvidia, and there's really no apparent reason for this kind of softer decline today. I talked to some traders this morning, and they were like, you know, it's healthy pullback. Like, what goes up must come down. But some people have been skeptical of this rally. We have Robert Knott of Research Affiliate saying that, okay, Nvidia may be riding a revolution in computer science, but this is textbook of a big market delusion. And when asked if Nvidia popping can bring down the whole market, he said it's possible. For now, Nvidia has rallied some 220% year to date, John.
What a ridiculous move year to date. Isabel, thank you. That stock this morning down by about 2.6%. The broader market on the S&P 500 pulling back about 0.5%, down a little more than 1% on the Nasdaq. Just to touch base with Apple again, that stock is down this morning by something like 4%. 7 minutes into the session. Turning to earnings, GameStop reporting second quarter sales that beat estimates in the first report since the retail chain ousted its CEO. Third Bridge analyst writing this: GameStop's second quarter results show encouraging signs towards the company's ongoing transformation plans to regain its presence in the video game retail industry under its new leadership. Katie on top of this one. Hey, Katie.
Hey, John. Yeah, GameStop's first report with Ryan Cohen as executive chairman, and went fairly well. You take a look at sales, they rose to $1.16 billion in the latest period. Analysts had been looking for an average of $1.14 billion, so a beat there. They did see a loss of 3 cents per share, but that too was a beat. And of course, GameStop has been struggling with the fact that the video game industry has been moving to online distribution rather than selling physical discs. That's a trend that has been going on for a while, but recent popular releases have helped cushion that blow, at least for the past several months, for GameStop. In particular, John, The Legend of Zelda, Tears of the Kingdom, that sold 18.5 million units in 2 months. And all told, GameStop's game software sales rose 26% in the period. And a big part of the reason why we're talking about GameStop right now is because it was one of the original meme stocks. We're talking about up 200% in 2020, almost 700% in 2021. A much tamer picture now, particularly this morning. Shares off by about 4%.
Remember what you said about Man United? I know absolutely nothing about video games. You ever played The Legend of Zelda? What was the game called?
Of course.
I remember The Legend of Zelda back on the N64, like 25 years ago or something, maybe longer.
That's where all my memories are formed. I haven't played Tears of the Kingdom.
Tears of the Kingdom. Katie, thank you for that. Maybe that's for someone else. Katie, thank you very much. 9 minutes into the session, Apple recovering just slightly. We're down here by a little more than 3%. Seema Shah weighing in on the market implications of the big tech giant selling off.
We could see that some of those valuations of those big tech names, as they start to be pressured, that's going to pull down the wider market. For Apple specifically, it's a couple of months of maybe a couple of days even of struggles. And then the market goes back to responding and thinking about, well, what is the long-term productivity growth potential from Apple? And that's what drives the market.
Joining us now to discuss, Emily Rowland of John Hancock Investment Management. Emily, let's start with that pullback in tech. Are there reasons that you want to buy that pullback in places like Apple and elsewhere?
Yeah, certainly over the longer term. Look, the U.S. tech sector has been made of Teflon this year. It's up 40%. Nothing has touched it. So this news out of China, as Isabel just mentioned, maybe something of a healthy pullback. This is a stock that's certainly, not going to go under as a result of this. It's a higher quality name, great balance sheet, lots of cash. We think, longer term, those higher quality plays in the tech sector are going to be good for this late cycle environment. So certainly some short-term pressure here. Some healthy selling, but longer term, we still like tech.
Emily, last time we spoke, you were pretty defensive. Utilities, healthcare, is that still the case?
Yeah, it is. And defensive sectors haven't really gotten a lot of love as of late, as markets are clearly still not priced for a recession. What we've seen as of late is these bounces in things like the ISM services data. We've seen, this morning initial claims, retail sales have held up. So I think this is, resulting in the market sort of pricing in this reacceleration and growth. And you see it, of course, in higher 10-year Treasury yields. We've seen oil prices pick up, which acts as a tax on the consumer. We've seen strength in the U.S. dollar, which puts pressure on multinational firms' revenues. And so all of this good news is actually being priced in a bad news way. You think about higher Treasury yields, for example, that's going to cause mortgage rates to go up and auto loans and credit card rates to go up. So I think that some of this good news is actually masking some challenges that are happening under the hood, particularly as it relates to the labor market.
This really is a framing question, Emily, and it's in the eye of the beholder in many ways. You mentioned crude at highs for the year, iron ore, multi-month highs, 10-year yields near cycle highs, dollar stronger, all of that stuff. Do you view that as a reflection of an extension of the cycle, or do you truly believe that's a recipe to finish it?
I think it's the latter. A lot of this bounce that we're seeing across commodities is happening as a result of China stimulus. So while the ECB and the bank and the Fed and the ECB are all working to contain inflationary pressures by raising interest rates, meanwhile you're seeing China and Japan actually stimulate. So you're seeing this massive divergence in central bank policy, which is causing the Fed to sort of have to be the adult in the room. China's making the Fed's job a lot harder by stimulating. Obviously, there's some other elements going on here in terms of oil price supply cuts. But I think, again, this is a cycle that is likely to unfold into recession, and we want to be really careful about sort of experiencing a head fake here.
Does that mean avoid energy equities?
Yeah, I mean, we've been underweight energy for some time. I think our view, again, is that we do believe that the lagged impact of central bank tightening is likely to tip the global economy into recession. And in those periods, demand has become a much bigger dynamic than supply. So we think that globally demand for energy should ultimately moderate. We'll see commodity prices once again roll over as that recession starts to play out. But clearly, we're not there yet. We're still in this very tricky phase of the late cycle environment, and I think portfolio positioning should reflect that.
Emily, out of interest, what would change your mind? What would change your mind about all of this? What would you need to see?
I mean, I think if you want to live on, soft landing island, which is clearly, what markets are anticipating here, I think you do need to see inflation meaningfully come down. I think you need to really start to see oil prices come down. And you have to believe that there are not going to be cracks to the labor market. The fact is we're starting to see them. We look at things like job openings. They've gone from 12 million to 9.5 million. We look at things like the quit rate, which is back to pre-pandemic levels, which means basically you're not seeing people feel confident about just hopping jobs to get more wages. You're actually seeing, things like strikes happening now as employees try to get more bargaining power here. We look at challenger layoff announcements. They've gone from about 23,000 last year to 75,000 as of the month of August. So these cracks are forming. We do think, again, as company margins get compressed, the cost of capital is elevated, revenue growth is coming off record levels, companies are going to need to defend those margins. And the biggest cost for most companies, of course, is labor. So I think that those cracks are going to become larger fissures in the labor market. But again, all of those dynamics right now are being masked from some of this better than expected data on the services and consumer side, which, by the way, is lagged economic data. Friends don't let friends use lagged economic data. We want to use leading economic data, which tells us, again, we want to be a bit more defensive.
I'm guessing you don't think claims lead based on what we saw an hour ago.
Well, initial claims are probably going to be the most coincident leading indicator. So that's something that we certainly want to keep an eye out for. But things can change so quickly on a dime. Once we start to see these cracks become bigger in the labor market, you'll start to see initial claims going up. And at that point, it's in the price. So we want to look at, again, the higher yields available in fixed income today as a great opportunity to prepare. The time to repair the roof is when the sun is shining. We think that's now, which is why we continue to emphasize higher quality bonds for that more attractive income potential.
You make it sound easy. Emily, thank you. Emily Rowland,
Thank you.
There's nothing easy about this. 15 minutes into the session, we pulled back just a touch. No drama here. Recovering on the S&P, we're down about 0.5%. Apple, with a much bigger weighting of the Nasdaq 100, about 11% of that index. A much bigger move there on the Nasdaq. We're down by a little more than 1%. Coming up, President Biden planning to cancel Arctic drilling rights sold by Donald Trump.
Oil, ultimately, it's a linchpin. It's the driver of most commodities, and it's the biggest component in all the futures commodity indexes. So the fact that oil's reached $90 per barrel is significant, and it means that the whole commodity index pushes higher.
Team coverage up next.
Oil, ultimately, it's a linchpin. It's the driver of most commodities, and it's the biggest component in all the futures commodity indexes. So the fact that oil's reached $90 per barrel is significant, and it means that the whole commodity index pushes higher. Crude oil's rising only because of the OPEC cutback, because otherwise demand has not really shifted so much. I'd say the economic side for crude oil has been bearish to neutral.
Kona Hack weighing in on crude and the economy. The Biden administration curbing oil development in Alaska, cancelling leases sold by the Trump administration in 2021 to drill in the Arctic National Wildlife Refuge. The Secretary of the Interior telling reporters, with today's action, no one will have rights to drill for oil in one of the most sensitive landscapes on Earth. Public lands belong to all Americans. That move coming right after extended OPEC plus cuts from Russia and Saudi Arabia tighten the market, with WTI sitting at new highs for the year. Let's get to the team coverage and head back down to Washington, D.C. and catch up with Anne-Marie and Kelly Lyons. Kelly, how have the oil companies involved responded to this one?
Well, there's not that many of them, John. We should note that these leases sold during the Trump administration back in 2021, that auction was a little bit of a dud. Only $14.4 million in bids from two companies in the Alaskan State Oil Development Fund. So it is less about that potentially and more about the mixed messaging it sends from the administration. That is kind of what you are hearing from the oil industry and its representatives in response to this. A spokesperson from the American Petroleum Institute said this industry needs clear, consistent policies in place to support long-term investment. That is the thing here, John. If you want these companies to be making long-term production investments in the U.S., they need to know really what the policy landscape looks like. And this move may be seen as stepping back on that, which is why you're also having Alaskan representatives, senators, others critical of this move as well. Given Alaska is a very heavily oil-reliant state, though its oil production has been in decline from 2 million barrels a day on average back in 1988 to around 500 barrels a day now. So maybe this means not as much is going to be drilled in Alaska, but potentially not as much is going to be drilled in the U.S. in general if policy is seen as unfriendly. And that is problematic given you have a supply and demand imbalance in the market right now, which has driven prices to the highest they've been since back in June of last summer. And prices at the pump are much higher as well.
AMH, do you think this is how you flex your pro-climate credentials just before we're about to see a headline on record crude production in the United States?
Well, to Kaylee's point, what you're hearing from Congress is what Senator Lisa Murkowski is calling incoherent energy policy. On one hand, the Biden administration has been demanding the oil giants to produce more. He wants to get a lot more crude out in the market so it could trickle down and mean lower gasoline prices, which, by the way, are now nationally just under $4 a gallon. At the same time, this president, just like he wants to be the most pro-labor union president in modern history, he wants to be the first ever biggest climate change president. And in this case, as opposed to Willow earlier in the year, that massive ConocoPhillips project where he really sided with the industry as well as under pressure from the unions, he's siding with the climate change world and the activists who want to make sure that they're protecting this land. Yes, this land is a dream for the oil and gas industry, for the future of potential crude coming out of there. But it's also home to wildlife like polar bears, like caribou. And this administration says they want to promise to protect 30% of land and water by 2030, Jonathan. He's in a rock and a hard place.
AMH, thank you. And he might stay there going into next year alongside Kelly Lyons. We are about 23 minutes into the session. Your equity market on the S&P 500 is slightly negative. We're down 0.6%. Crude at the moment, WTI, $87 a barrel. Your trading diary up next. Stocks lower for a third session. Let's get to the trading diary. Coming up, Philadelphia Fed President Patrick Harker at the top of the hour. More Fed speak through the day. Williams, Bostic, Bowman. Saturday, the G20 summit kicking off. Sneak peek of next week. Tuesday, Apple iPhone launches a little bit later next week. And on Wednesday, we'll get US CPI. That is your main event for the economic data about a week away from New York. That does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.